So picture this. You're finally doing the responsible thing, right? You start saving money every single month. $100 here, maybe 200 there, and you feel good about it. You feel disciplined, financially mature, the whole shebang. But then, one day, you open your banking app and realize something super frustrating. You've got, say, 10 grand sitting there in your savings, and it's earning what? A 0.5% interest rate? That means after an entire year of doing everything right, you've made $50. Meanwhile, you keep hearing everyone else talk about investing and index funds and compound growth, and you kind of have to ask yourself, wait, am I doing this completely wrong? Well, you're definitely not alone. That exact scenario is where so many people just get stuck. They know saving is incredibly important, obviously, but they have absolutely zero idea how to safely move from saving to investing without feeling completely overwhelmed. So in today's explainer, we're going to dive into this and completely reframe investing. We're taking it from this perceived scary gamble to what it actually is, a totally necessary foundational tool for your financial freedom. Here is our quick roadmap for this explainer. 1. The savings illusion. 2. The math of wealth. 3. The psychological barrier. 4. The 5-step path. And 5. Investing for freedom. We're going to cover exactly how to transition your money safely out of stagnant accounts. Starting right off with Section 1, the savings illusion, why saving alone rarely builds wealth. Now look, it's absolutely crucial to validate those good financial habits. Building savings is hard work. But the source material we're exploring hits us with a pretty controversial truth. Saving money alone is almost never going to make you wealthy. And that's because saving isn't the end goal. It's literally just stage 1. See, savings and investments are doing two completely different jobs for you. Savings protect your money, but investments grow your money. If you're trying to use a basic savings account to actually build wealth, you're just using the wrong tool for the job. Which brings us to Section 2, the math of wealth, the cost of playing it too safe. Let's look at the hard numbers here, because this is where it gets crazy. If we compare a typical 1% savings account to the historical 10% average return of the S&P 500, the massive gap that compounding creates over 20 years is just undeniable. Imagine you start with that exact same $10,000. You leave it alone for 20 years in a 1% savings account, and you end up with about $12,200. Not great. But if that exact same money was invested at a historical 10% return, you're looking at roughly $67,000. It's the exact same starting money, but a wildly different outcome. You've really got to realize that playing it too safe actually comes with a massive mathematical cost. Honestly, the biggest wealth gap out there isn't between the people who save and the people who spend. No, the real divide is between people who save and people who actually invest. All right, moving to Section 3, the psychological barrier, why the transition is so hard. So, if the math is that obvious, why do so many of us get stuck? Why doesn't literally everyone just invest? Well, it turns out it's not about the math at all. It's entirely psychological. It basically boils down to this. Saving feels incredibly safe, and investing feels risky. When your money is just sitting in a savings account, you can see it. It's stable. It's not going to magically drop 5% on a random Tuesday afternoon. But investments, they move around, sometimes up, sometimes down. And that emotional roller coaster is exactly what scares people right out of the market. The sources use this brilliant analogy that I absolutely love, and it perfectly captures the mental shift we need to make here. Think of saving your money like storing seeds in a glass jar. Sure, you're protecting them perfectly, but absolutely nothing is ever going to grow in there. Investing, on the other hand, is like taking those exact same seeds and planting them in the soil. At first, it looks super messy. You don't see any immediate results, you got dirt everywhere, but over time, it grows. Eventually, you get something way bigger than what you started with. Investing is a natural growth process, not just some blind gamble. Okay, Section 4, the 5-step path, how to transition without losing sleep. Now, if you're sitting there thinking, okay, that sounds great, but I really don't want to lose my hard-earned savings, I totally get it. That is completely fair. To help beat that fear of volatility, we're going to walk through a super clear, actionable 5-step path. Step 1, build an emergency fund. Step 2, mentally separate saving from investing. Step 3, start small. Step 4, focus on simple investments. And Step 5, stay disciplined. Let's break these down so you can actually implement them. Step 1 is absolutely critical. Build a real emergency fund. Before you put a single dollar into the market, you really need 3 to 6 months of living expenses saved up in straight cash. And listen, this is not for opportunities. This is strictly for unexpected disasters. A job loss, a medical emergency, your car breaking down. Why start here? Because the number one reason people panic sell their investments at a massive loss is that they suddenly need the cash. A solid emergency fund protects your investments from your own life.
Moving on to step 2, mentally separate your saving from your investing. This is a total game changer for your peace of mind. Just picture your money sitting in 2 different buckets. Bucket 1 is your safety money, it does not move. Bucket 2 is your growth money, and it is completely allowed to fluctuate because its only job is to grow over the next few decades. Just making that mental split dramatically lowers your anxiety when you watch the stock market bounce around.
Step 3, start small. A lot of beginners assume they need thousands and thousands of dollars to even start investing. You really don't. Plenty of platforms out there let you start with just 50 or $100. And the truth is, the goal at the very beginning isn't to make massive profits anyway. It's just to build the habit. Getting into that monthly rhythm matters so much more than trying to perfectly time the market. For step 4, focus on simple investments. Beginners so often make the huge mistake of diving headfirst into complicated crypto speculation or day trading. Just don't do it. Keep it simple. Look into low-cost index funds, which basically just track the overall stock market. You're essentially buying tiny pieces of hundreds of companies all at once, which gives you built-in diversification and lower risk. I mean, legendary investor Warren Buffett has repeatedly recommended low-cost index funds for most people. Turns out, simple usually beats complicated. And finally, Section 5, Investing for Freedom, the power of consistent discipline. Let's look at how staying disciplined, which is step 5, and just giving compounding enough time to work can completely transform your future. The most powerful investing strategy is, honestly, kind of boring. It's just consistent investing. Imagine you put $300 a month into the market. If it averages an 8% return, after 25 years, you would have roughly $285,000. But here is the crazy part. Think about the ratio. Your actual out-of-pocket contributions are the tiny slice, just $90,000. The massive majority, almost $195,000, comes entirely from compound growth. You're literally letting the market do the heavy lifting for you.
But what if the market crashes? Right? That is the absolute scariest question for new investors. Well, market crashes are totally normal. They've happened dozens of times throughout history. But disciplined investors, they stay calm because they know a little secret. Long-term investors actually benefit from market downturns. When prices drop, your monthly $300 just buys way more shares at a heavy discount. So when the market inevitably bounces back, your returns are even stronger. You really have to train yourself to think in decades, not days. Which brings us to the core truth we've been building up to today. Saving your money gives you stability. And yes, we absolutely need that. But investing gives you freedom. When you finally combine the rock-solid stability of savings with the aggressive, compounding growth of investments, you create an incredibly secure financial future for yourself. So, I'll leave you with this final, provocative thought from today's sources. What is the true cost of letting your money sleep? Are you going to keep protecting those seeds in a glass jar? Or is today the day you finally plant them so they can actually grow? Think about it. Thanks for joining me for this explainer, and I will see you in the next one.